Market started the week off in absolute free fall, but possibly already recovering. We have a lot to talk about tonight, so we're going to go ahead and get right on into things. Yeah, really a lot to cover. The last few videos, I've talked a lot of theory, had a lot of good feedback on that, and I think I just want to go a little bit deeper in that theory. And so we're going to talk theory in the second half, but kicking things off, let's actually talk where we're at now. A massive sell-off kicking the week off. Everyone has obviously seen the headlines at this point. I think we're down almost 4.5% from Friday into the lows on Monday, but already we're starting to see a very strong recovery today as I'm recording this Thursday evening following the close. Market's up about 2.5% just on today, so a very strong recovery looking already underway. All the headlines I saw is that effectively the yen carry trade blew up, and then that caused a cascading event, funds to go bust or something like that, big liquidity event. Listen, I'm not particularly convinced by the carry trade argument. I won't get into that, but regardless, the one thing I will say is, look, the argument we've been making to this point is that the main driver of equity prices, the main driver of stock prices, which are the fiscal flows, which is government spending, the main driver had really given way heading into July. We knew we were in thin air. We knew a sell-off was possible. And what ends up happening when you get extremes, particularly when you get extremes like we saw in volatility, just getting very compressed into the highs of kind of mid-July or the lows of volatility in mid-July, is when you get price to really diverge from underlying flows, the market will start to find the weak links, and those weak links will get exposed, and they will get exposed sometimes in the most spectacular fashion, especially those that have sensitivity to volatility and to leverage. This whole scenario reminds me of what played out in Volmageddon. If you remember back in 2018, February 2018, we had this massive run-up from August of the prior year into the end of July. I'm sorry, into the end of January, early February, and we had a sudden spike in volatility that created a cascading event that just blew up fund after fund after fund, ETF funds, right? And we saw from peak to trough, I think, almost a 12% sell-off in very short order. Following that, we still had some pretty big spikes, big volatility, but eventually market volatility settled, and we climbed into almost Q3 at that point, September, October, before a real bear market set in at that point. If you want to know where we're headed next today, I actually think February of 2018 gives us a pretty good playbook for how I think things are headed going forward. We might still be in for some volatility. We might still see some big swings, but we are going to see flows kick right back into gear here, and I will expect ultimately price to start pushing higher, and probably by the end of the year start to vie to make some new all-time highs. I'll kind of explain that in a little bit more detail in just a second, but overall, I think, again, what happened in Volmageddon is very similar to what happened right now. And the big drive home point is, look, when I start saying and I start seeing flows really diverge from where price is at, and we start getting in this thin air, I don't know if we're going to see a crisis emerge, a collapse emerge like we did on Monday, or if we're going to see something a little bit more subtle play out like we did in April, or if something like the end of 2023 is what's going to play out. You never know what's going to play out because you don't know where the weak spots are. You don't run every fund. You don't know who's positioned to expose to what sort of outcome. But you can always kind of be, not rest assured, but know that there is always the risk there when flows really go against the underlying trend that has emerged, and we saw that play out. And sometimes it just turns out that certain trades are set up in a way where they're going to get absolutely punished, have to liquidate, and make a little mini crisis emerge. So that's kind of my take on what happened here. And ultimately, though, I do think we will recover in part just because those flows are going to start to come right back on board. In fact, they already are as we speak. The 90-day average just starting to tick up from that big collapse that we saw from the June tax drain, and as we kind of saw price really diverge to that point. So the longer-term trend is going to pick up. Now, one of the things that even within the MMT camp that has been being pointed out here is that, look, if we end up getting a rate cut, which looks almost inevitable now, or rate cuts, which almost look inevitable at this point, that means the overall rate of change at which deficit growth is happening is going to start to slow down, and that will have an impact. And I agree. I really agree with that point, and that is something we need to pay attention to into the future. If these rate cuts or the rate hikes go away and rate cuts start bringing yields down, that will start to slow things down. But my counterpoint, my big counterpoint to that, and this is where we're going to get into the theory in the second half of this video, is that we are really seeing a strong credit cycle emerge at this point. And I think that is what a lot of people are discounting, even in the MMT space and throughout the kind of macro world as well. And I'll show you why markets can sustain growth, why the economy can sustain growth for quite a long time, even if the fiscal starts to give way. And I don't see the fiscal giving way in any spectacular way. Certainly we could slow down, and that's not good for kind of a bullish market thesis, but we can still see the private sector endogenously create the money that it needs to continue to grow. So that's really going to be the argument that I'm going to make on the second half of this. But just to kind of put a bow on where we're at now, I do think ultimately by the end of this year, we're going to have recovered. We're going to start pushing higher. Is volatility probably going to be higher now than it would have been had we not had the real blow up that took place on Monday? Yeah, might something like what played out in February, where we get that kind of second leg lower and that big scare lower, maybe a month or two later play out? Probably. We could easily get something like that. Certainly the September into October tax strain period would be kind of right for that to play out. But ultimately, I do think speculation will win out, and we'll start to see markets climb higher. And so that is my overall my overall thesis now as it stands. So onto the theory part, onto kind of the fun stuff here at this point. What's the first thing that has to happen? The very first thing that has to happen is ultimately we get the rate cuts that kind of everyone is clamoring for at this point. Now, when I looked at this data on Monday, it was looking like 100 to 150 basis points by the end of the year, absolutely locked in, easily 50 basis point cut into the September rate cut already. We're seeing a bit of moderation in terms of rate expectations. If we look for the last meeting of the year, it's not looking like that full 150 is absolutely baked in. So we're starting to see a strong moderation, a tempered expectation for rate cuts, in part because already we're just seeing a few news items come out that are a little bit hotter than expected. And certainly if that trend keeps up, I actually think it will, then there has to be tempered expectations for rate cuts. Now remember, the reason we bring all this up, the Fed has it backwards. Rate cuts actually slow down markets, the economy. Rate hikes actually boost growth. The Fed has it backwards. Even market participants have it backwards, so they clamor for the Fed to make cuts when they see slowing as opposed to hikes when they see slowing. So yeah, they've got it backwards, and then we have to play both with the acknowledgement that the Fed has it backwards and market participants have it backwards, but that ultimately the underlying flows will win out. That's the game we're playing. Gets a little confusing, but suffice to say, if cuts end up coming in, then yes, that is going to start to slow down the overall acceleration of credit spending. And so what I'm going to bring up right now, acceleration of deficit spending, which is exactly what I'm going to bring up right now. Now, we started to see this slowdown already take place in the kind of second half year of 2024 after that huge surge in 2022 from those rate hikes. And what I want to point out is historically we can go a little while even in negative deficit or positive surplus territory, right? And we can see that in the lead up to the dot-com bubble. We had a surplus for quite a long time, very low spending heading into the great financial crisis, moderate spending in the 2010s, and then obviously in 2022 we had that surplus. And again, this is inflation adjusted, and this is cumulative deficit spending and the rate of change. That's a little bit different than just the pure surplus deficit, but I think a better measure to understand where we're actually at. So what is it? Why is it that we can kind of get this sustained growth to kick off and have a credit cycle play out that endogenously creates the growth going forward, even when the government stops the spigot of those financial assets heading into the private sector, which create that necessary profit and capitalization of the private sector to expand on? That's what we're going to talk about with regards to the theory. And the answer is because once the private sector has those elements, has those ingredients in it, it can create the necessary profits endogenously that it needs to continue the cycle. Again, we'll show the theory in just a second, but I want to set the stage a little bit more just to show that I do think, and I mentioned this in the last video a lot, we are still in that stage of the early parts of a credit cycle. In fact, we just had the senior loan officer survey come out, and they are just showing that they are loosening their standards and that loans are continuing to increase. Exactly what you would expect at the beginning of a credit cycle, not at the end of a credit cycle. And so those are really the components that we want to look at. But maybe a better question is there a way to actually model this dynamically? Can we see this ebb and flow and kind of prove this theory out that that's exactly how this will play out? Well, you can. You can actually build this out in System Dynamics package, formerly called Minsky, now called Ravel. And I reached out to really the foremost authority on system dynamic and macroeconomic modeling, Ty Keynes, and asked him, hey, would you help me put together the very model that you're seeing on your screen that's going to model the various theories that I've talked about for many, many years, and see if we can demonstrate those in Minsky, now Ravel, in a systems dynamics package. And so that's exactly what we have on our screen. And we're going to go over this in a ton of detail in just a second, really just show, hey, this government spending thing actually does help fuel the credit cycle. So before I show you each element of this, even cooler news, check this out. Ty and I, we've been talking a lot. We've been putting this together, and he also put out his recent national model. It's insane. You have to check it out if you haven't yet over on his channel, Relearning Economics. I will certainly link that in the description below so you can check that out. But his national model, absolutely awesome. We've been taking elements of this to go ahead and build into the Minsky model that's on your screen, but we're going to be going over that and over all things Minsky, all things theory. Yeah. On our live stream, we're bringing that back. So if you're not subscribed and you don't have that notification bell on, get subscribed and then look out for that stream if that's something you're interested in. But back to this video, what this model is actually doing is really just demonstrating some of the core thesis to the kind of applied MMT approach. Again, that idea that when the government spends, that adds financial assets to the private sector. It allows the private sector to leverage. And then from there, kind of the more heterodox endogenous growth takes over. The profits increase over time. The debt level increases over time. And you see a credit cycle play out, given that kind of initial burst of fiscal spending. And eventually the credit cycle gets so large, the acceleration can't continue, the whole thing ends up collapsing on itself. And that's exactly what this model ends up demonstrating. So what we're going to do is we're going to start off in this model, and we're going to go ahead and have government spending turned off. But in the system itself, we actually will have, in the initial conditions, we will have a initial capital stock as well as a minimal amount of government spending money already in the private sector. And so we're going to see essentially an endogenous only system play out. And the way that I had this built out is I have just kind of the classic production function where you're going to have a company hire workers, they're going to spit out widgets. Those widgets are going to get bought with the income that's already in the economy. As profits grow in the investment function, that's going to increase the amount of debt accumulation, so the private debt ratio is going to grow. This will create the feedback loop that will ultimately feed back into the production function. You'll create more widgets and whatnot, increasing profits, increasing the amount of debt that then gets accumulated, and you get this feedback loop that builds upon itself. And so that is just kind of the classic Goodwin plus Minsky sort of model. So what we're going to do, we're going to zoom on in and we're going to look at the charts that are ultimately produced, or that ultimately track the data that is produced by the model that we're about to hit simulate on. We're going to go ahead and start the simulation and start to look out and look at the various data points that we can track. The three that I want you to pay attention to: first, the employment ratio, so that's the amount of people that are employed in our little model. The profit ratio, so out of growth, how much the firms are taking in profit out of that growth. And then the last is going to be the overall debt ratio. So this is the ratio of debt relative to the growth of the economy. In other words, as debt is expanding, private debt is expanding. This is expanding the growth of the private sector. And then in the classic kind of Minsky Goodwin type model, what ends up happening as the debt load increases, employees start to ask for higher wages. This eats into the profit ratio, and eventually you get to this inflection point where profits start getting eaten away from so much that you end up seeing mass layoffs. And once you end up seeing layoffs reach, we'll get to that point in just a second, kind of a critical inflection point, you end up seeing the system completely fall apart with no way to kind of save the day. And then you end up seeing a complete system collapse, and we are never able to get the cycle started again. This is essentially what happened in 2008. And if there's no outside exogenous addition of new income into this system, you'll just see the system collapse in perpetuity for all of time. Now, this time, what we're going to do is resimulate this exact same thing, get it off the ground, and at about the same time that we saw the crisis emerge last time, so I think in the chart that was around 50 or 60 years, we're actually going to turn on government spending. And what we did to get the government spending to kind of simulate, strong stimulus sort of spending is we tied it very aggressively to unemployment to never allow unemployment to get too far out of hand. And so if you were unemployed, you'd get essentially an unemployment check, and that's not going to add funds into the private sector. So we're starting to see that instability show in the employment ratio. That's what I'm looking at right now. So let's go ahead and do this. We're about to collapse. Let's turn on government spending. You'll see in the bottom middle graph here, the tax and spend, treasury spending absolutely takes off. And what ends up happening, you end up compressing the cycle again. Profits stabilize. And on the far right, the public debt ratio takes off, and the private debt ratio starts to stabilize as well. Now, you might look at this and say, whoa, wait a second, Doug, you're almost killing this cyclicality of this, right? You're almost getting to equilibrium, but ultimately we're not. What's really interesting about this is even when you turn on a very aggressive government spending, eventually what happens is you start to see the private sector once again usurp the public sector in terms of spending. And we are going to see in just a second, although it's not going to be chaotic, we actually start to see in the bottom middle graph, the treasury spending start to give way. In just a moment, the private debt level will start to inch ever so slightly higher. We can spin this up or speed this up just a little bit, and we can see that exact dynamic play out, but we're not going to get a complete system collapse. We'll get kind of a mini recession, if you will. Unemployment spikes, see a little bit of chaos entered into the system, but eventually we'll start to actually see, once employment gets out of control a little bit here, we'll see that stabilizing spending kick in, recapitalizing the private sector. And again, as we talked about and how this thing works, when the government spending, that's adding income to the private sector, they're able to buy the widgets that are being created. That creates profits for the private sector, and that kicks us back into that kind of upward sloping Minsky investment function, and therefore the credit cycle kicks off again. And as we see in the debt ratio, in fact, the debt ratio starts to pick up as the public debt ratio begins to fade. And that is exactly what we see play out in real time. So this is the applied MMT model. Like I said, get subscribed. We're going to talk about this with Ty himself, talk about each step of the theory in the live stream for the next few weeks. So if that's interesting to you, make sure you're ready for that. But now let's bring this back to the actual data itself and see if we can see the same dynamic playing out in the real data. Again, we have this ebb and flow, deficit spending, public spending, very similar to what we saw play out in the model. We're far from the absolute bottom of the range, if you will, of deficit spending, but suffice to say, we had the big push in 2022 into 2023. We're leveling a little bit, but like I was saying, the credit cycle is just starting to take off. And as we were mentioning earlier, it looks like we are very much in the early stages. The other thing that's playing out too, and I didn't mention this before, is the total private debt level to GDP has decreased substantially over the last few years. So relative to where we were at back in 2008, at the height of the crisis with the massive credit expansion, we still have a lot of room to run for us to get back up to that point of kind of critical weight overall private debt to GDP. And so just like in Minsky, where we can plot the various outputs of our simulation, particularly in kind of this phase plot style, we can do this as well in our actual data. And what I've done is plotted the three main factors that we are paying attention to that shows where we are at in the cycle. Right now, private debt to GDP level is on the x-axis. On the y-axis is government spending or deficit spending, and then on the z-axis right now is the credit expansion or contraction itself. And if you plot these in 3D space, you can actually witness in real time the buildup of those major inflection points in 2000, in 2008, and in 2022, where we saw the three main bear markets that we've had in the last few decades. So again, just looking right now on the looking at the x and y axis here over time, each time we get on the y axis into negative territory for deficit spending, that is when we oftentimes find ourselves at that inflection point for recessions or major sell-offs. And what the color coding is on each one of these dots is the 9-month forward return of the S&P 500. And so what I can do is just kind of shift this in three-dimensional space, and you'll see that it's each time that we reach that surplus zone where we start to kick off the selling cycle. And I can kind of show you that it was like early 2000 is when we kind of hit that inflection point for the 2000 sell-off. In 2022, it was around April where the kind of worst of the deficit spending had hit, and then in 2008, again, early 2008, we were at the worst of it for deficit spending. So in time, those are the three inflection points. The next thing, too, that we wanted to take a look at is that build up over time of private debt to GDP. How much of GDP is private debt taking up? The higher it gets, the higher the likelihood is that we're going to have an even more extreme sort of, kind of burst in volatility. And again, as you move left to right, each time that the private debt to GDP ratio gets higher, it really exacerbates the risk at hand. Now, the next element in this, and this is a little bit more difficult to see, is going to be this private credit. And it's at the top of each cycle. It's the acceleration into the top of each cycle that is where the inflection point or the top of the overall cycle happens for the macroeconomy. And so I've shaded out just a little bit of an area to show that once again, it was as we were heading into early 2000 for the dot-com bubble, or again, April 2022 of the 2022 bear market, or again, as we were kind of headed towards early 2008, that the worst of it was going to happen because we were accelerating credit into those inflection points. And so you get accelerating credit into a low government spending environment, and that is ripe for the conditions necessary that we saw in the Minsky model to get that sort of Minsky sell-off. Because the main insight from Minsky, the main mathematical insight from Minsky that people like Professor Steve Keen have built upon, is that when you get to a sufficient point of private debt to GDP, what ends up happening is you have to have continual acceleration from credit expansion to continue growth. And it's just impossible for a economy to go ahead and do that, continuously have acceleration, and that's eventually where you get the breakdown. That's what we see over and over again. So the question is, where are we right now in that system state? Well, in that system state, we had that massive acceleration in government spending already take place in 2022, so we're well capitalized. But more importantly, if you can see this blue dot, let me spin it right here, and I'll get right on this blue dot for July is where this data is coming from, and hopefully you can still see this in three-dimensional space. We are just beginning the credit cycle upwards. And if you note where we're at with this blue dot in terms of forward expectations for the S&P 500, they're not that bad. Most of it's green, most of it's positive around this general area and below this line. So we're at the beginning stages of this credit cycle. And if you plot where we're at in this credit cycle, in the dimensional space of kind of historical playing out of the dance between the credit cycle and deficit spending, you'll see that we are just at the beginning stages with sufficient government spending to support forward growth. And even if that government spending continues to drop a little bit more, we're still very early on in this credit cycle where it would be a while for us to get to the upper part of the private debt cycle where we need to get worried. So this is quite a few ways to kind of chop up just a few very simple points, which is we had a massive wave of government spending. Yeah, it might be abating now because rate cuts are going to come in and it might slow things down, but we are still at the very beginning stages of this credit cycle. Not only do we have the data to prove that out, but we also have the underlying theory to prove that out, and we can simulate how this can continue into the future with those tools. And as it stands right now, I see nothing at this point that gets me terribly worried that we're in some major kind of a slowdown or pullback in growth at this point. I think all the seeds are in place. The seeds are sown for a continued credit cycle into the end of this year and likely into 2025, if not further at this point. So I know we've hit on some points that we have recently in the past in prior videos and kind of touched on them again, but I've had so many good questions, so much good feedback that I thought it'd be good to kind of reiterate all this once again in more detail and really drive home this point. So I am going to wrap things up. But before I take off, if you are an active trader, active investor, head on over to appliedmmt.com. And look, all the tools that I have available throughout these videos are all available on the data dashboard. You can get access to everything that we publish. Yeah, check it out, appliedmmt.com. But that's all I have for tonight. So until next time, good trading, everyone. We'll talk to you then. Bye-bye.